So as usual, we start off just with a little disclaimer. So trading involves the risk of loss of capital, not suitable for everyone. And of course, if there's leverage involved, you can lose substantially more than that initial investment. The views, opinions, all the information that's continued in these YouTubes and other content that we put together is purely for educational purposes. We are not trying to encourage you to trade or invest. That has to be your decision. And of course, you should carefully consider the risks, your financial situation, level of experience, definitely your risk appetite as well. And of course, you should only risk capital you're prepared, but more importantly, that you can afford to lose. If you have any doubts whatsoever, seek independent financial advice before risking your capital. Very important, that bit. Okay, so let's move on to what happened last week. There wasn't that much data out last week, but there was still a lot going on. So, German factory orders were lower, month on month, that is. And also the EU retail sales were down 2% year on year. In the US, data went weaker than stronger. So, if we look generally at the data, I mean, it gave investors hope at the start of the week in the US. However, come Friday, that was destroyed. NFP data probably would have caught a lot of traders out. Their instinct is to, when the data's good, that they expect the market to go up. But that's just not the case with the current macro picture. Generally at the moment, again, when central banks are involved, it all goes a little bit skewed. And that therefore sort of, the good data means that the central banks are going to keep being more aggressive with their stance on rates, where they are trying to counter inflation, or at least the consumer driven part of inflation. So manufacturing slipped as well. PMIs were okay. Jolts now, Jolts came in and with that, sort of the job openings dropped, and ADP was strong at 208,000. ISM was strong, so it was a beat at 56.7. So it's all a bit sort of jumbled up at the moment, and that's sort of what sort of caught investors out last week, I would say. The early part of the week, they was expecting the Fed to cut back a little bit because the data wasn't strong enough. But then towards the end of the week, when it came to jobs data and such like, then the strength came back. And as I was saying, when that strong data comes out, you've got to expect the central banks to be more aggressive with hiking rates where they're trying to get control back over inflation again. And of course, last week there was plenty of central bankers providing their insight. And again, some mixed views there on how aggressive they should be or backing off even. And Australia raised rates to 2.6%. That was only a 25 basis point hike, and there was quite a few that expected 50. However, New Zealand did increase by 50 basis points, and their rates now are at 3.5% already. And then, of course, we had OPEC plus that cut production by 2 million barrels a day. US dollar dipped early week because of the data, and then recovered strong on Friday, again with those expectations of rate hikes. Stocks were up and then crashed on Friday. Oil strong, just purely on fundamentals. So when we look at the sort of key data that's coming out this week, first of all, just keep an eye out for corporate earnings if you're dealing anything, you're trading anything stock related. It's the end of the third quarter, so we've got to expect all of the performance so far to be posted. So just be ready for some of that, especially the big companies, because they're the ones that are really going to sort of impact the stocks and the indices, of course. In the US, got lots of data out, PPI, CPI, inflation data. So that is going to be really, really relevant again to what goes on with the Fed soon. Also, Monday is a holiday. Just to sort of highlight that, just so you're aware of that. Michigan consumer sentiment, retail sales, and of course on Wednesday we've got the FOMC minutes as well from the last meeting, so that'd be watched with keen interest. And then we've got the WASDE report, commodity report, that is coming out. In case you don't know what that is, that's the World Agricultural Supply Demand Estimate. So it gives you a good insight into what expectations are going forward for the demand for commodities. And of course, just got to look at that supply and demand for sure. Then when we move on to the UK, unemployment and earnings. So again, they're going to be important for the pound this week. GDP for August. Again, keeping an eye on that. You know, remember GDP is like that full health check of an economy. It's goods and services, industrial production, manufacturing, and again, you know, they're going to be important to see how we're doing. You know, to be honest, I'm in the UK. I walk around the shops. Everyone's full of shoppers. You know, people are buying. They've got carrying bags with them. Supermarkets still full. So, you know, don't get fooled. You know, there's a lot of negative information and data coming out about the UK. And sure, you know, we're heading for a recession, the same as pretty much everywhere else eventually. But economically at the moment, or consumer-wise, you know, the demand is still there. In the EU, not so much coming out. We've got industrial production, and then Germany, France, and Spain. We've got CPI. Again, just remember PPI, CPI, inflationary data. Very, very good to look at. And in China, they've got their CPI out as well. You know, where everyone else is sort of going in for tightening, China's not in that area at the moment. They're still adding stimulus. And of course, they've got problems with real estate at the moment. So, macro outlook. So when we look at inflation, it's still sticky in the EU. It's just hit 10%. So, you know, we're not seeing that drop down at the moment. Now, part of that for me is caused because, well, you know, I would expect PPI to be dropping just purely because raw material prices have been coming down, making that little bit cheaper for producers. However, we're not seeing that reflected in CPI as companies keep the cost savings for themselves. You know, their profit margins are above 15%, which is the highest it's been for decades. Now, stagflation, you know, this inflation without growth is already impacting some countries. And of course, over time, that is going to go from stagflation into full-blown recession. And, you know, there's going to be many countries that just go straight into recession as well. When it comes to supply chain issues, you know, there's a variety of those still around. We've still got OPEC. I mean, obviously, as I've mentioned, they was cutting. They decided to cut by 2 million barrels a day. Now, you know, that in itself is not, you know, it sounds a lot, and it is. But the problem is that they've got a quota system. You know, they're allowed to produce or export so many barrels per day. And I don't believe that they've been able to even fulfill those quotas. They haven't been able to produce enough. So, again, for me, that means that, okay, they're 2 million barrels off the market, but it's not really 2 million barrels because they weren't producing that full amount anyway. And of course, you know, now there's going to be potentially EU and possibly other countries coming out with further sanctions against Russia. Now, Putin could, if he had a mind to, really cut the oil supply down. So he could go from just sort of achieving or meeting his quota to actually dropping his supply substantially more, similar to what he did with the gas, or what he's doing with the gas rather, uh, and only export to his friends. And again, you know, he hasn't got so many of them these days. So, you know, he's got some like big ones like India and China that have got massive populations, obviously. So the demand is there for sure, especially as he discounts it. But you know, again, we just got to watch that because we saw what happened to the price of gas. Is the potential there for that to happen to the price of oil as well? You know, I mean, it's possible that they could counteract that a little bit, but it would take America to lift sanctions and controls off of Venezuela and or Iran for that to happen. Okay, so also we've sort of still got China with some lockdowns, and as I mentioned earlier, that they still have a real estate crisis that's ongoing. So I'm not sure what's going to happen there. And of course, you know, Ukraine is fighting back still. They're making progress. They blew up the bridge to Crimea from Russia, which again is embarrassing for Putin. Energy prices moved up on all of that. And, you know, with European temperatures dropping, big question is, are they going to have enough over the winter? So, you know, it's difficult. You know, we've still got we've definitely got energy inflation. We've still got some food inflation, but as I say, it's not quite as high as it was. But again, we've just got to keep an eye on the weather fronts. There's still that lack of workers going around, which is keeping that earning pressure up. And that's probably sort of part of why companies aren't passing on any savings at the moment. So this is quite interesting. This is from ING. When you look at the macro outlook, so I'm just going to let you sort of absorb what it tells you. So look at the key at the bottom first, so that you understand it. It's just relative importance, so 1 to 3. And it just looks at energy prices, political, government, central bank, financial, and COVID. But I thought that was a really interesting chart. So just talking a little bit, just to give you time just to absorb that. And of course, you know, you can always pause it while you do study it. It's definitely worth taking note of. And of course, the countries: US, Eurozone, UK, and China.